Joining me, Diane King-Hall, Senior Markets Correspondent, and Mr. Alex Coffey, Senior Equities Contributor and a host of Next Gen Investing. Here with me in studio, and Diane's joining us from the NYSE. All right, so Zoom and Palo Alto. We were just looking at the market making moves on these, Alex. They're about roughly the same. Palo Alto, they're looking for like an 8% swing, and Zoom a little bit less, but I feel like either one of these could go pretty big.
Yeah, I think I would lean, and even though it is the slightly higher one just based on the market, it just feels like there'll be more action in Palo Alto Networks. There's more eyes on cybersecurity now than there is on video conferencing. Although Zoom Video does have, plans that they're trying to lay out, trying to integrate AI into whatever they're working on. So there's potential for them to excite the street one way or another. But I just feel more market impact from Palo Alto than Zoom, so that's where my focus mostly would be.
Okay. Agreed, a more important stock. What do you think, Diane? Where's the excitement going to be this afternoon?
Absolutely. I have to 100% agree with Alex that it's going to be all about Palo Alto. Zoom doesn't have the same luster that it had. I mean, you remember it was a pandemic darling. It doesn't trade anywhere near. I mean, yes, it has beat for several consecutive quarters in a row. So the expectation is that it will hit its numbers. If it doesn't hit its numbers, I mean, it's traded around this 60-plus range for a while now. It would really take a huge catalyst for it to break out. It talked about AI and integrating it in its last earnings call, but not in terms of it being an additional price or cost to its customer base. It's basically an add-on. So where is the growth coming from? That'll be one of the questions. So Palo Alto seems to be the one that's winning the popularity contest. We'll see if it wins the numbers.
Yeah, the Zoom trade largely forgotten, so I will be concentrating. I don't know, maybe I'm becoming a closet Zoom stan. I don't know, I just feel like I was kind of surprised when we were talking about it this morning that they are actually still growing, even if it's like a tiny little bit. All right, but Palo Alto is obviously going to be more important for sure. In fact, it kind of started to go up as we were coming into the bell, so it's like some conviction was building on it. I mean, it got slammed so hard in the last earnings that there's a really important kind of check-in here to see where tolerance is. This price earnings to growth multiple for Palo Alto is 4 times what it is for NVIDIA, Alex. So, I mean, they could treat Palo Alto here very differently than they're going to do NVIDIA because it's way more expensive.
Yeah, it's software, though. It's a little bit more scalable, I would say, in terms of like the growth percentage trajectory. I get that NVIDIA has broken all hardware norms and it's grown a ton, but that is not a sustainable forever trajectory.
Sure.
You can kind of hyperscale technology. We know cybersecurity is increasingly important. So you can understand why there's this payout for growth, but I think what interests me is that they just flat out didn't deliver last quarter. It had a huge spike lower, and it was like 2 days of selling, and then everyone was ready to jump back in the water and has been grinding this stock back up. Look, a lot of damage was done. It's nowhere near where it was, but it really didn't have a sustained move lower once that big drop. It's pretty much been working its way higher for the better part of the last month.
They're going to be showing the slowest growth since their IPO, Diane. So again, I don't know. Yeah. Both these companies. Maybe Zoom don't look so bad.
Well, yes, sure. And I mean, look, on a price perspective, sure, it's cheaper. But Alex makes a great point. Look, it sold off really hard. Okay, good. It sold off really hard off its last results, which were disappointing. But analysts have gotten back on board and said, look, maybe it was an overreaction. And then that this quarter, they see it as this starting the process of rebuilding. So we have to see, what their new guide looks like, especially because the last one was a surprise guide down for their last quarter. Are they out of the woods and are they gaining more market share from their customer base, especially when they talk about the platformization and doing, I hate that word, but that's a word that they've used, doing more one-stop shopping for their customer.
All right, numbers out here. And yeah, that's a good point about the business strategy for those products. The revenue for the billings growth is expected to come in just shy of 4%. That's the number I'm looking for right now. And they're $3.43 billion. That's the outlook. Here, I'm going to give you the outlook first. For the next quarter, 3.43 to 3.48 billion. The street was looking for 3.47, so maybe on the high end, they get there a little bit. Their trailing revs did beat $2 billion. I mean, it's a marginal beat versus 197. Adjusted EPS of $1.32. I mean, the outlook, I'm not sure that this is going to be good. Yeah, here we go. It's getting hit because it seems like they narrowed that down a bit.
Aftermarket is off. Yeah.
So it seems like they narrowed the outlook. And then I think a lot of analysts are going to be disappointed with the outlook generally because they just, if they hit it perfectly, then they'll basically hit the estimate. So the range is kind of below where they're looking for at least next quarter.
Guidance is a disappointment, no doubt. The estimate for the full year was just under $10.2 billion, and they narrowed the top end of the range to below the estimate. On just the fourth quarter billings, it's $3.43 billion to $3.48 billion. They were looking for $3.47.
Right, yeah, that's the one. So if they basically get to their top end, that's a slight beat.
Fourth quarter revenue, same story. Top end of their range is where the estimate was. So it's light on guidance, and this was sort of the risk coming in. I know that we kind of laid this out as this is an optimistic space to be in, but it's becoming increasingly crowded, and companies are unwilling to sign long-term contract deals. So they need to show billings growth because they don't have them locked in for as long as some of the software companies had been getting contracts locked in for. So disappointing. Not surprised to see it move lower, especially given the fact that the stock has ground higher over the last few weeks. So basically in line with the market maker move, but you could see this one accelerate to the downside if there isn't a spin here in really short order.
Yeah, I don't know how they're going to spin it, Diane. It just seems like everything's kind of almost ground to a halt. I mean, look, the revenue on the trailing basis is still 15%, but when the billings are going down to single-digit growth and missing, it's just a far cry from the company we used to see report a couple years ago.
Absolutely, and I think the expectations were ratcheting back up heading into this report, especially based on the last quarter. And, there was some grace and forgiveness shown to this company, but that's out the window, at least in the initial reaction. We'll have to hear more on the earnings call in terms of their response to this, and particularly more details on the guidance, what's going on with their customer base and this new one-stop shop plan. Zoom's out as well now. They reported adjusted EPS $1.35. That does beat the expectations. Revenue $1.14 billion, just above the bar. Looking for more numbers on guidance. The shares are on. Shares are lower in response. Not as bad as Palo Alto in terms of the response, but the expectations were certainly higher for Palo Alto in terms of that response. So both getting hit in the after hours.
So the overall move here, I guess, definitely bigger for Palo Alto. So, all right, we got that question answered. That was kind of our first question. The fact that, we could kind of talk about the trajectory of these companies in the same breath is not good. Again, like I was saying earlier, because Zoom technically does have a tiny little bit of growth going on. But, in some very broad way, the whole kind of software boom still in this post-COVID funk is kind of now reaching Palo Alto, it seems like. It started with the weakest links, which was clearly Zoom, which was, for many people, kind of a one-off thing during COVID. But now the fact we're having these conversations with Palo Alto is where it gets a little more deep.
I don't know that it was a one-off thing, Oliver, but I think you highlighted this in the setup, though. It's not that they're losing customers. They're just not growing anymore. So start paying up for this growth as if it's going to just happen this way forever. At some point, there's just no more fish to fish out of the pond. I mean, the big, I think, disappointment here on this report from Zoom, and I know the stock's not reacting that strongly, their customer ads, so their enterprise ads, comes in at 191,000. They were expecting nearly 225,000. That's almost a 15% miss. On the part where they've had some bright spots lately, which is they've been getting some of the bigger companies that have over $100,000 in revenue with them, that came in 2% under the expectation. So not as bad, but it's missing. So despite the fact that there's been recent optimism around Zoom, thinking that they might win some business with that unbundling of Teams from some of the other Outlook products, it's not really coming to fruition here. So I think it's a disappointment. But if you look at how the actual financials shaped up, they were marginally better. So maybe they're getting more efficient in how they're operating, but the growth isn't really there in terms of net customer ads. In the case of Palo Alto, expensive stock, there just was no room for disappointment and disappointed.
Like I said, their PEG ratio is 4.
2 times in a row now, by the way.
2 times in a row they've missed. To the point about Zoom, I mean, free cash flow, at least, they got a couple $100 million more than the street was looking for. It just product-wise, for Zoom, Diane, it's like, we've been asking what else you got, and they haven't really given us anything for like a year and a half.
Exactly. I mean, it's you can't quite call it a one-trick pony, but it's it's kind of that. And to Alex's point, yes, they've cleaned up things and created a more efficient operating environment, but where are they going to go for growth? Could they partner with someone? Maybe that's the question that Zoom needs to turn to. The other tough thing when you think about just the way this week is set up, it's most of the attention is going to be paid to earnings this week because we have a very light economic calendar. So where's the direction going to come from for the rest of the week in terms of this market?
Yeah, that's where, look, there can be a separation of church and state between basically everything else. Yeah. And NVIDIA, because again, as much as NVIDIA's rallied, the valuation less egregious than what we saw for Palo Alto. So for Palo Alto, there are a lot of chinks in the armor, and I think an arrow just kind of flew through.
The risk in NVIDIA is that every single person thinks there's going to be a beat and raise, and look, it probably will be a beat and raise. So it's just trying to find what's good enough. But that being said, there's very few times in markets where one name can not only just take down itself, but potentially take down a market or bring it higher too. Semiconductors as a whole are going to move in reaction to NVIDIA. If NVIDIA is positive, you're going to see ARM holdings. You're going to see SMCI have reactions that are positive too. If it's negative in any way, even if it's a beat but not by enough, you're going to see ARM. You're going to see SMCI move, if not more, in the same direction is my speculation. In the case of Zoom, to kind of tie this back, Zoom was so successful and got such a boon from the pandemic that they outpriced themselves from the acquisition markets. And now they've allowed all those companies that might have been interested to just create the software competition. So
really
the issue I have with Zoom at this point is if they don't find sort of an off-ramp to more business, I just don't know how this isn't one of those stocks where it kind of just slowly but surely grinds lower just simply because it's ubiquitous technology.
Yeah, they're going to have to figure out a way to wring money out of it to keep people interested in staying in the stock if there's not going to be a buyout or an obvious partnership.
It's still $20 billion.
Yeah. Here's the thing, though. Again, here's what I would say, though, is that there's a lot of people on there still. I mean, 3,800 customers that are contributing more than $100,000 in Q1. So that's kind of commercial level. I mean, it is commercial level. And look, I'll just go back to the valuation math. Zoom priced earnings to growth is actually less than what Palo Alto is, which is a good thing. So, I mean, it's kind of a weird shifting of where you're paying up for growth at this point, Diane. Not that both of these offer a lot, but compared to each other, Palo Alto doesn't look that wonderful.
It's true. It doesn't. And look, I mean, but for Zoom, what investors are getting compared to what Palo Alto is taking a hit. But, by comparison, Zoom has just, it's fallen for years. It's so far off of its high. There's no way it's going to kind of come back to that. It's closer to its IPO price now than its all-time high.
Yeah, it's true. Alex, give you last thought real quick.
Yeah, well, I was just going to kind of give you the counterpoint. I agree with you. In the case of Zoom, the one thing that is a positive is it's positive on EPS and it's positive on free cash flow. So even if the growth does grind down, it's still generating money. It doesn't need the growth story at this point to justify, I guess, long-term that it has value at all.
Yeah.
There's so many names in this market that just don't have profits. So the fact that it can point to that, say, hey, we don't need to borrow money or issue stock to survive, it has that going for it.
Look, I've never been a Zoom lover. I just feel like, I don't know, I just kind of became a Zoom stan in a minute there, just looking at the way, it's single-use product. It might be a one-trick pony. Palo Alto's got a lot of ponies in the stable for sure. But it's just got really expensive, so the market's punishing it right now. Zoom kind of getting a little looser shake. All right. Thank you, Diane King Hall. Appreciate it, and Mr. Alex Coffey.